some of you may have had experience with the 12B and the solar initiatives that the government's put out in terms of tax breaks. And there are a lot of people doing it, but I've found these guys to be the best when it comes to deploying the capital properly, doing everything that you have to do so that you actually get this benefit, retain the benefit, get the returns that you expect to get. And obviously, I'm not going to steal Jonty's thunder. I'm going to let him tell you about it. And Jonty, thanks.
Good. Thanks very much. Cool. Hi everyone, thanks for coming through and thanks for spending the time. I'll be taking you through the Section 12B tax incentive, and I think what you will realize is this is probably the best tax incentive we've ever seen in the country. And you know, my business has been in the tax incentive space for many, many years. And this is the last year to really take up this opportunity. Section 12B, and I'll touch on it in a moment, it's been around for some time, but the government gave us a 2-year window period to get an additional tax benefit from it. So originally it was at 100%, now it's at 125%, and I'll show you what the numbers look like. But this additional enhancement to the incentive makes it quite a no-brainer from a tax perspective. And I'll take you through the numbers and I'll run you through it. But ultimately, what's extremely appealing about this investment is you're getting roughly 90% of your capital that you put in back in the first year. And you're getting exposure to what we think is a really low risk asset class, which is solar. So low risk, and you're de-risked very, very early on in the investment. Jaltech, we've been around for more than 10 years, 14 years now. One of the owners of the business. I have 2 partners, both actuaries, started the company, and we're a large shareholder. It's a private equity fund called Capital Works. They bought into the business about a year ago to help us really scale the business. And we've got over 2 billion under management, more than 1,700 investors, with our current fund that's going to go probably in the region of just under 2,000 investors. So there's a lot of interest in our products. We've been in the market for some time. We've got a really reasonable solar portfolio, 27 megawatts, over 160 solar assets. You can think about a spa or a garage which has solar on its roof. We own these assets and we sell electricity to these tenants or the property owners, typically at a rate cheaper than Eskom, and they benefit from the saving, and we benefit, and our investors benefit from the income. And because our investors own the asset, they get the tax benefit. And that's how we pass it on. We've already invested 400 million rand into this market, and we're about to deploy another 200 million rand in the next couple of weeks. I think what's really important is track record. When you look at a fund manager, historically we raised over 1.5 billion rand in Section 12J, which is another tax incentive, which we're probably the leading fund manager. In the solar sector, this is our 4th fund. But this is our 3rd fund of this nature. We've got a different fund, it's a bit more complicated, but the fund that, this fund mirrors our 2 historical funds. They're both doing extremely well, as you can see on the slides. The yields are on average 16% over the term of the investment. That's pre-tax, that's after fees. So effectively our investors who invested R1 million. Over the term, they'll anticipate yields of around, on R1 million, about 160,000 rand a year. That's ignoring their tax benefit. Which is a really nice yield, and I'll talk you through how the yield works and how we calculate it. But from an IRR perspective, the internal rate of return, it's extremely high, 35%. And that's not because we are wizards with numbers, it's the tax benefit. The tax benefit is upfront, it enhances the return, and that's why the 35% is so high. And as long as the end customer is creditworthy, we'll look to finance their solar solution. And credit is something I'll keep bringing up because that's, I think, is your major risk. We'll raise money from our investors, we buy solar, we install it on someone's roof, and then we sell them electricity. And the real question is, the people we're selling it to, can they afford it? And are they going to pay? And that's your major risk. And I'll talk you through this risk, and I'll hopefully settle your nerves around what we're doing in this market to mitigate this particular risk. Moving on to Section 12J, just so you get a sense of the legislation. It's been around since 2016. Originally at 100% tax deduction, and I'll show you on the next slide what I mean by that. Now it's at 125%. You're entitled to this tax benefit if we take your capital, we buy solar assets, so that's solar panels, inverters, and batteries. We buy these assets, we install it, and they produce electricity in this financial year. That brings me to another risk of this investment is if we don't deploy the capital into new assets in this financial year, you won't get your full tax benefit in this year. You'll get it partially this year and partially the next year. So to give you an example, if we raise 100 Rand and we only finance 50 Rand, you'll only get 50% of what you've given us as a tax benefit. The other 50% will go into the next year. So by investing in this fund, this is our premium fund. This is our first fund of the financial year. You're best positioned for us to deploy all your capital. And we're going to be raising another fund like we did last year in September. And our September investors will be at risk of not being fully deployed. And if I look at our past funds, so our first fund of last year, fully deployed, our investors got full tax benefit. Our September investors got 90%, which is still very high, but there is an additional risk if you invest later in the year. So this is our premium fund. This fund will also incorporate debt, which I'll explain. And for us to deploy both equity and debt in one financial year it's a big feat, but there's enough time in the year. If you're going to be investing in our September fund, you'll be at risk of not getting that full tax benefit on the debt, which I'll explain. I mentioned this is the last year to get the enhanced tax benefit, and this is really what the benefit looks like. So here we have an investor or an individual taxpayer. They earn 5 million Rand, and as a result, they're paying tax on 5 million, and that's roughly just over 2 million Rand in tax. Now we have the same investor who now opts to invest 1 million Rand. Because the investment is 125% tax deductible, they can reduce the 5 million by 1.250 million Rand, and therefore they'll only pay tax on 3.750. So it reduces your taxable income, it reduces the amount in which SARS calculates what you're going to be paying. So with this reduction, you get a tax saving, and the tax saving is 562,000 Rand if you're in the highest tax bracket. So what this saving means is if you are a PAYE payer, if you invest with us now, in August, next month, when you submit your provisional tax, you will make provision for this investment and you'll pay 562,000 Rand less in tax in August. You'll get the benefit immediately. If you're a PAYE payer, like most of us are, what happens is you'll invest, you'll carry on paying PAYE, your company will withhold your income tax, and then in July next year, you'll file your e-filing and you'll note a Section 12B investment, and we provide investors with a guide on how to claim your benefit, and then you get a refund. You literally get money back from SARS. We've got a lot of experience in the tax incentive space. We've got, as I mentioned, over 1,000 Section 12J investors, and not a single one of them didn't get their tax benefit or their refund, and we're very confident and comfortable in this space, and got a track record and experience of assisting our investors in getting their tax benefit. Any questions on this calculation? Because this is a fundamental point.
So that $1 million, does that have to be a lump sum, or they say if you are PAYE, you can make monthly contributions?
It needs to be a lump sum. Our minimum is 500, and how we do it is investors will sign a commitment form. We ask within 10 or 14 days that half of your committed capital be deposited. Once we have deployed that money into projects, we then do a subsequent drawdown for the balance. And so in other words, we won't be sitting on your capital, we'll draw down your capital as we're ready to deploy the capital. We raise capital, we compete with the banks, we go to large corporates and who are looking at solar, and we offer them a funding solution, a debt finance solution, which is long-term, 10 to 20 years, and the banks can't offer competitive rates, and I'll explain to you in the next slide why. But effectively, we are a debt provider into the commercial and industrial sector, and we are financing solar. A solar installer will give a quotation to a client. In this example, it's an office park. It's a 10 million Rand solar installation. The client will say, they haven't made provision in their budget for 10 million Rand. They're going to approach the bank. What will happen is the solar installer will bring the client to us. We'll give the client a proposal within 24 hours normally, where banks will take many weeks. After we've done a really in-depth credit assessment, and the client goes through our investment committee, and is approved, we'll then finance the entire project. Now, we own these assets. We buy the assets, we install the assets on their roof, and then we sell them electricity. The sale price is effectively a loan, where we are selling them electricity at a predetermined rate, normally around prime +2, and they're buying electricity from us. We invoice them monthly, and the solar installer who we've done a in-depth due diligence on, they'll do the installation and they'll do the operation and maintenance for the next 10 or 20 years. Now, this is exactly where the banks play, but there are a couple of competitive advantages that we have, which make our offering far more competitive than the banks. And the first is we'll finance the entire project. Banks, when they offer funding, they'll only finance around 70%. Second, banks only finance over 5 to 7 years. Now, if you finance solar over such a short period of time, the annual payments will exceed what the system produces from a rand value perspective, where we can finance over 10 to 20 years. And why this is beneficial is our cost, what they're paying us every year, let's say on a 10 million rand installation, they're paying us R1 million a year, that the system is producing 1.5 million rand of electricity. So they're in a cash flow positive position. They're paying us R1 million, they're generating 1.5 million rand of electricity, they are cash flow positive 500,000 rand. Where with the bank, it'll most likely be the opposite. They're paying in 500,000 rand more to the banks than they are consuming. So our offering is extremely competitive, and our turnaround time is exceptional. We're not a large bank, we can make decisions quite quickly. We've got a really large team. I'll take you through our team shortly, but we can make decisions quickly and we can operate. So putting in perspective, in December, within 4 weeks, we reviewed a business, did a credit assessment, and the installation took place within 4 weeks. In really December, where a lot of people were taking leave. So we're nimble and we can move quite quickly. Where the banks take, we raised 150 million rand from the banks recently. That took us a year, and we are in the financial services space. So when a bank asks us a question, we can answer it immediately because this is our business. We own the business of finance, and it took us a year. Where think about another corporate who's running their business, building their business, they don't have time to answer thousands of questions that the banks ask. We can, and yet it still took us a year. So if we can finance within 3 months, it's still really, really, really impeccable. And as I mentioned at the beginning, the real allure here is we can return approximately 90% of your capital in the first year. And I'm going to explain how we do that. As I mentioned earlier, if you invest $1 million, if you're in the highest tax bracket, the tax benefit of this investment allows the investor to receive 562,000 rand back from SARS as a tax benefit in the first year. What we then have done is we then raise funding from one of the banks. RMB is our bank at the moment. We raise debt based on the million rand that we have raised from our investors. And we raise it on a ratio of 2 to 1. So for every 2 rand that we raise 1 rand of debt. So in this example, an investor will give us R1 million. We'll finance R1 million worth of solar. The banks will then give us, off the back of that solar asset, 500,000 rand. Now this 500,000 rand is really raised in the hands of our investors. We will then use that 500,000 rand to buy additional solar. So in the same financial year, what happens with the investor is he gets another tax benefit of 289,000 rand. And that's because of the debt. So these two sums, plus some cash flows in the first year, the two tax benefits together give you 850,000 rand. That's all from SARS. That's not any wizardry from our side. And then in the first year, there are some cash flows. I'm going to talk you through them now. And those sums, these two sums combined, gives you around 900,000 rand, which this investor contributed R1 million. So this investor received 90% of their capital in the first year. They de-risk 90% upfront, and then they generate a return on the R1 million. So another way to look at what I'm saying is you have two options. Your one option is you invest R1 million with us, and you receive 850,000 rand from SARS, or you're going to be paying 850,000 rand in tax because you can't escape it. This investor, an example I gave, if you're in the highest tax bracket, depending on your income, in the example, this investor will be paying 850,000 in tax. So they can either pay the tax or invest a little bit more than they would have paid to SARS with us and receive the tax back. That's how I really see it as an investor myself into this fund, is I don't want to pay any tax. I can assure you, I'm pretty confident we'll give you a really nice return. Yes.
On that, so let's say on the 900,000, do you then pay capital gains tax on it?
On the 900,000 that you
Pay
receive?
capital gains tax.
So all the refund that you receive from SARS, it's capital in your hands. You're not paying any tax on it. Where there is tax is in the investment returns, which I'm going to explain now on the screen.
So is there a minimum number that you're talking about? Not the fund, the person's taxable income.
Yes.
What's the maximum? What's the minimum to make it viable for that person?
I'm kicking myself because I actually had a slide on that and I removed it. Personally, I'm investing a sum of money which will bring my taxable income to around 360,000 Rand, which will put me, I think, in a 28% tax bracket. So that's where I position myself. So, in other words, and I'm speaking about myself, I'm not giving anyone advice. If I earned R1 million, I would only have to invest around 400,000 Rand to get me down to 330, because my 400,000 Rand plus the debt times 125% brings me to about 350. But if you're interested in investing, we can do that calculation for you, and you can make a decision based on your taxable income. Because a number of our investors, they position themselves where they're trying not to pay any tax, so they have trusts and they have all different company vehicles. There are ways of mitigating the tax in all types of vehicles. So you can invest with us as an individual, company, or trust. So what you'll see on the board on the screen is the cash flows. Now, the first line is the tax benefit. The second line is what we anticipate to yield in the first year. And then the third line is another tax benefit. And what you'll see is in year one, it's 43,000 Rand, which is 4.3%. In year two, it goes to 5%, and then almost 6%, almost 7%, 7.6%. What I'm demonstrating is the number goes up. And why this is when we price our solar packages, for lack of a better term, we do it on the basis that we need to be competitive with Eskom. So how we do this is, in the first year, our energy consumers, we try to price it that they pay us as little as possible, less than Eskom. And in the following year, we increase it at 6%. The following year, we compound it by another 6%. And we escalate the payment profile of our energy payments by 6% over the 10-year term of the investment. Now, what this does is it makes sure that our pricing on day one is cheaper than Eskom. They want about 36% next year. We're only going up 6%. So we will remain cheaper than Eskom. And it allows us to have a very compelling offering to the energy consumer. So from our investors' perspective, the income over time becomes more and more and more significant as the rate escalates. These rates are also after we've paid the bank's annual interest rate. So, if we weren't paying the bank, the 43 would be around 73, which is significantly more, but there's an interest component towards the banks that we have to pay. So they scale up really, really nicely. And then what happens in the 10th year is we make an assumption. Now, what we're seeing currently in the market is when we sign with an energy consumer, they want to buy electricity from us for around 15 to 16 years. That's where the market's at the moment. But we don't want our investors in for that length of time. The investment term is 10 years. Most investors will get 90% back in the first year, so you're almost exited in the first year, but the investment term is 10 years. But we are signing deals of roughly 16 years in length. So what happens in the 10th year, we've got 6 years left of cash flows. And it's very common in the market, not only in solar, in most asset rental spaces. And the remaining contract term is sold to one of the banks or to the likes of Merchant West, Mercantile, financial institutions that buy long-term contracts. And what we do is we add up all the future cash flows and we discount it. And that discounted sum equates to roughly 1.1 million. And that lump sum is paid to our investors. Now, what a lot of people may be asking, okay, well, that's a great assumption. What happens in year 10? You get to year 10 and you can't sell it. Well, the cash flows from year 11 to 16, they are really high. And they are more than 20%. So if you invested R1 million, you can anticipate in year 11 receiving 200,000 Rand. The reason why they're this high is the bank loan is for 10 years. So at year 10, we've paid off the banks. We've got 6 years left of cash flows at a really high rate of around 20% per year. So worst case scenario, our investors are in for another 6 years, but they're earning really nice cash flows. The asset has a 20-year lifespan. So we're not going to get to a position where at year 13, these assets start not performing. All these assets have warranties for 20 years from really large manufacturers. So we'll be able to make sure that these systems produce for the remaining 6 years. All the numbers you see in front of you are after fees, but they are not net of tax. So tax will have to be taken off. The tax is income tax. There's no capital gains tax in the structure. And what you will see is the IRs, the internal rate of returns. And after tax, it's 21%. And 21% is a number you commonly see in the private equity market, where you're investing and you're getting a 21% IRR. But this isn't the risk level that you're taking in private equity. Private equity, you're taking high risk. Here, you're taking risk that the end customer will pay. We've done an enormous due diligence on them. And if they don't pay, we have recourse and various types of recourse, but we can also collect the asset and put it on someone else. That asset doesn't go to zero. And you'll also have exposure to 25 to 35 solar assets. So if one defaults, it's not going to materially impact your investment. There'll be some cash flow reduction for a period of time until we redeploy the asset. This isn't a venture capital or tech investment which will go to zero. So we can just redeploy the asset somewhere else. Any questions before I move on?
You talk about 90%
De-risk.
paid back in the first year.
If you're in the highest tax bracket.
Sorry?
If you're in the highest tax bracket.
Well, you assume that everyone's in the high tax rate.
That's what I'm assuming,
Yeah.
yes.
So, how do you get to 90% tax rate?
Sure.
Can you give us a breakdown of that calculation?
Sure. Here it is again.
Okay.
So the investor invests $1 million.
Right.
The $1 million is deductible at 125%, so you can reduce your tax by 1.250. If you take 1.250 times 45%, that's the tax saving, 562,000 rand. Okay. We then raise the debt.
Why do you raise the debt?
We raise the debt to allow investors to enjoy the tax benefit in the same financial year. And the tax benefit, it's large, it's 125% for this year only. So by raising the debt, we're de-risking our investors even more. So it's to your benefit for us to raise the debt.
And they don't sign surety for their debt?
No. Investors do not sign surety. The banks only have recourse against the solar assets. So if there's a catastrophe, every single one of the 25 or 35 solar assets default, banks can only go after the solar assets. They cannot go after our investors directly. So what we haven't taken into account in the numbers is two line items. One is wheeling. So our agreements allow us to own any excess electricity. That electricity, at some point in time, we'll sell it into the grid. It's only available in the Western Cape and in Port Elizabeth at the moment. We haven't factored that into our calculations. And we also haven't factored in carbon credits. So if you produce green energy, you have something called a carbon credit. These carbon credits are then, you can then sell them in the open market. We are finalizing, we've already agreed terms, we're finalizing with a carbon credit provider in South Africa, and they'll be selling our carbon credits, and we anticipate that our investors per year will receive an additional 0.7%. So it's not an enormous amount of money. It's like if you invest R1 million, it's extra 7,000 rand, but it's not nothing. That also hasn't been taken into account in the numbers. But as with any investment, it's not without risk. There are a number of risks, but I'll mention what we think are the major risks. And the first, as I mentioned, is deployment. So if we raise money, if we fail to invest it, investors will only get a tax benefit based on the amount that we do invest. But we've done a lot of work in this space. This year alone, we've signed 15 exclusive term sheets with some of the leading solar players in the market. And what this means is we've tried to corner the market where we've gone to the large solar installers, some of the large financial institutions, and we've got exclusive arrangements where they have to bring us all their solar business. We then review it, do a credit analysis. If we like it, great. If we don't like it, we pass it on. The total term sheet value is over R1 billion. Whether they'll bring us R1 billion or not, I'm not sure. But what I can tell you is this year alone, we've priced. And what I mean by that is an installer will bring us an opportunity we'll review the system, we'll do indicative pricing. So we'll do a quote, basically a financing quote, and we'll send it to the solar installer. We've done 4.1 billion rands worth of pricing this year. Week on week for more than 14 weeks, we've priced more than 120 million rand a week. Just to give you like a real sense of the numbers, May we did 565 million rands worth of pricing. In June, we only did around 480 million rand. Big numbers, but because of load shedding, what we are seeing is the conversion rate slowing down. So load shedding was a wonderful thing for our potential customers. They had 3-4 daily reminders that they need to consider alternative energy. Load shedding is no longer, so they're not being reminded as much. But for now. But our pricing is cheap, and I'll put things in perspective. We can finance solar in the day at 99 cents. That's to a corporate who in summer rates is paying 150 and in winter rates is paying 230 to Eskom versus our 99 cents. So it really makes sense for them to go with us. We'll also guarantee production, take full responsibility of the system, maintain the system. All they need to do is pay. So it's a really great proposition. We've done so far this financial year about 200 million rand worth of transactions. They've gone through our investment committee and have been approved. So we're well on our way. I really think that this fund will be fully deployed. I'm an investor in this fund and other funds, but deployment is a risk. So I'm not standing here saying you will be deployed. I think the probability is high. In a business of more than 25 people, this is our solar division. It's headed by my partner, Derek Kai. He's one of the co-founders of the business. He's an actuary. He manages 5 CAs who all they do is transactions every day. We have 2 and soon we'll have 3 full-time lawyers in the business. All they do all day is churn out legal agreements. And then we've got a business development team, which I'm part of. We raise capital, but also we bring deals into the business, and then my partner's team will go through the diverse opportunities. The other risk is credit. So if we do a bad deal, obviously returns will be impacted. But I gave you a sense that we've already priced 4 billion rand. What this gives us, we think, is the cream of the crop in the market. Really, out of those businesses, if we do transactions with 10%, we basically hit our goal. Every week, that number is increasing. So we really think that we can experience the cream of the market. I mentioned we have 160 solar assets. We have 0 defaults. We really think we understand credit, we understand collections. So credit is a risk. We will have defaults. It's part of business, but we really think that we're mitigating this based on the huge volume of deal flow that we have at the moment. The last risk is Section 12B risk. And this is something I need to just disclose. There's a technical tax point. And the point is, if you want to get 125% tax deduction, you need to be at risk for 125% of what you invest. So if you invest R1 million with us, you need to be technically, from a SARS perspective, at risk for 1.250. And what this means is, let's say there's an event and the fund gets sued for more than its assets. What would happen, and if we lost the court case, our investors would have to put money in. We think that this risk is extremely low, have enormous amount of insurance on theft, damages, third-party liability. The property owner who the asset is on, they need to have their property insured, the insurer needs to approve the installation. We really think that there's extreme low risk of this ever happening, but I need to disclose it so that you understand. And if you didn't have this risk, you wouldn't be entitled to claim 125%. But it's important that you understand this. And then just lastly, investment highlights. Our minimum is 500,000 rand. We aim to return 90% in the first year. The investment's asset-backed. You're not investing into a dream or an idea. You're investing into a physical asset. Every year you further de-risk or exit it through the return that we will pay. We actually pay out roughly every February, March of every year in a lump sum payment. The net IRR is really high in the highest tax position. And because of the gearing, to your question earlier, the gearing allows an investor to get 187% tax deduction because of their contribution plus the debt. The combined tax deductibility on your original investment is 187%. We've capped our fundraise. It's capped at 250 million. The fund is closing at the end of the month. Nicola and the team, I can assure you, we will hit our 250 million rand cap. We more than 220 million rand into that fundraise, we are fully allocated. So in other words, our investors have an allocation. We're fully allocated. Assuming everyone takes up the allocation, our fund would have been capped.
So thanks, Jonty. I think it was quite enlightening, and if some of you haven't seen it, some of us have been through a few presentations and we understand what happens, but it's always good to go through it again. One of the questions I've always been asked, so I'll ask it, is for some of our clients, well, why haven't you shown this to us before with the fund? You know, I think when it starts off, there's been quite a few sort of less than professional guys that started out in the game, and it's all about deployment. You actually have to make sure that these funds are deployed within the same financial year. So let me ask the one question: what happens if I gave you my R1 million and you didn't deploy it?
So firstly, we draw the capital down in tranches. So we will draw down 50% now. Only once that capital is committed will we then do a further drawdown. The alternative is we draw down the full amount. We hope that we sit on the capital, and then we let you know at the end of February, sorry, we only deployed 60 or 70%. So that's not how we do business. We'll commit the first tranche, we'll then review our deals, and we'll then take a view. Do we draw down 25%? Do we draw down 50%? And we don't want to be in a position where we're sitting on investors' capital. So by and large, our intention is whatever you've deposited with us will be deployed. It might mean that you commit $1 million but only invest 750. But whatever you do eventually deposit with us, we believe that will be deployed into the market.
Okay. So worst case scenario, I've either not deployed the full $1 million that I've committed, or alternatively I get a refund. So exactly as we discussed. Okay, so that's just the question around how it works. But I mean, you guys are closing out now, and the reason I got this meeting together is so that those of us here can actually take the benefit of the 125, because that hasn't been renewed into the next year. It might be, but we're not sure about it.
Yeah, all indication is not going to be renewed. What we do understand is that originally it was 100%, and our understanding from the Treasury is that the 100% will be reinstated. This additional 25% will fall away. So that's why I was saying that I really think this is the last year we'll ever see such an enormous tax benefit, and it makes sense why government introduced it, because government needed help from the private sector to produce electricity, and this incentive has really done that.
So how much has actually been taken off? Because I think people also magically think something happened, that Eskom didn't get better, guys. Okay, what actually happened? So you're in the industry, you're doing it, so we're talking about the numbers.
Last year, over 2,000 megawatts of rooftop solar was installed by the private sector. So it's a huge amount. And the forecast is for that to grow every year for the next 3 years. We've commissioned a president, which is one of the authorities in the electricity sector, to produce a report for us at the moment. But we anticipate around 1,500 to 2,000 megawatts to be added to the market by the private sector every year.
What's the number that's actually come off the grid, as in from Eskom's not provided? Someone was saying 18 gigawatts in terms of the totality.
In terms of what Eskom's producing?
No, in terms of what's been taken away. So that's why Eskom doesn't have the strain.
What I can tell you about Eskom's strain.
4,900.
There we go. We've got some electrical cats.
So electrical, by the way. Yes, electrical.
Yeah. Okay, cool. So
but what I can tell you now is Eskom, they're producing around, I think, 30 gigawatts at the moment. And one of the reasons, and this is in my words, this is from the former deputy head of National Treasury. He publicly stated, I think last week, that his view, the reason why there's no load shedding is because the mining sector is in a recession, and the demand from the mining sector is very low, and therefore there's excess electricity. So if the mining sector had to switch on, his view is load shedding would come back.
So can I just ask, talk about commitment and a payment.
Yes.
So when you commit, say we give you R1 million to commit, but you only draw down or pay into account as and when you require one of the funds.
Correct. And we'll give you ample time. We're not going to message you, email you tomorrow and say, hey,
So the idea is that when you sign up the investment with clients, as Mont Blanc, we tell you you've committed R1 million. Remember, we're going to call on half of it within 30 days, so to speak. remember it's closing out now, so they're going to be deploying it. So you should really expect to spend that money in the next month, 2 or 3.
Our forecast is in September to do a final drawdown of the remaining capital. And our ambition is to deploy R1 billion in this financial year. This fundraise with the debt would be around 450 million. So, the balance of 550 is something we are driving towards. So we're quite confident that within a short period of time, we'll do a full drawdown and deploy all the capital.
If they implement solar tax,
if they do?
Yeah.
Gotta play it as it lasts.
So the question is, who they're going to implement solar tax on?
On the users, on the solar,
on the consumers?
Yes, on the solar consumers.
That's the consumer's problem. We're the producer. If they impose a tax on us as a producer, what we do have in all our agreements is a provision for change in law. If there's a change in the law which affects our ability to sell electricity, we have an option to sell the assets to the end customer. The end customer has no option but to buy it. And we call these trigger events. So a trigger event would be a change in law, insolvency, default in payment, a force majeure event, a breach of the agreement, and the whole bunch. I'm a lawyer by profession. And if any of the trigger events occur, we have something called a put option, where we then force the consumer to buy the solar asset from ourselves. And this is not an abnormal clause in these type of agreements, and the banks have similar provisions, because ultimately what we have is an end customer who would have gone to a bank is now coming to us. We're not going to take on regulatory risk or government risk or legislation risk, so we pass it on to the end customer.
But I mean, one of the things I'll say about that question is, when you've priced competitively on your actual production of electricity through the structure, every year, if you're increasing and the contract says 6% and you're having crazy, increases like 37%, you might get to a point where the Eskom tariff versus what you're getting, even if there was a tax, it's still going to make financial sense, guys. So, I think that this is a good investment, and I know that a lot of people have a lot of questions around it. And I like to simplify it like this. We every day invest people's money into the stock market. There's no way that you're 90% de-risked. You invest in Eskom, Sasol, that money's gone. If that share goes from $100 to 0, it's gone. There's no problem. We're going to give you your $90 back while you still watch your investment go up. Guys, it's like, yes, this could happen, that could happen, but the fact of the matter, there aren't investments out there that we go, no problem. Let's give you 90% of your investment back while you watch your investment produce a 16, 18, 22% return. And then you still have a sweetener at the end on an exit where you're getting, time over money, you're getting 1.1, but you're back again earning the exact capital you put in, plus all the returns you did. So I'm just saying is that, yes, lots of things can happen, but I don't know about another investment that goes, no problem. After the first year, you invested in Tesla, let's give you 90% of your money back while you watch the share grow up. It doesn't happen, guys. So I'm just saying is, it is an amazing thing. I mean, the question would be, we've had this other one, is what? It's too good to be true. What's the catch? Okay, why did they do this? And you can give us the example about how they lose the money versus in the market. Every day, what the fiscus was losing a day, a week, a month.
Yeah, I mentioned earlier, they've done this because of load shedding. And the tax benefit it's in the legislation, it's very clear. There's SARS rulings on the tax structure, so not doing anything here which SARS is going to wake up one day and go, well, what are they doing? SARS has issued rulings, almost like an opinion or an explanatory memorandum on how Section 12B works. And we fit perfectly into their requirements, and we have legal opinions from Cliff Decker-Hofmeyr, one of the leading law firms in tax. The reason it feels too good to be true is because of the tax, not because we found this amazing way how to triple your money. This point earlier is, one of my earlier slides is, if you're in the highest bracket, you invest $1 million with us, we're getting $850 back from SARS. If you don't invest, you're going to be paying that to SARS. It's gone. You're never going to get a return from it. So what you got left as risk capital is 150,000 Rand. And it's that 150,000 Rand, which, you know, I was trying to demonstrate on the slides that in year one, you're 43,000 and then 50,000 and then 57,000. That's really on the 150 because the balance you receive back from SARS.
The actual investment was 150,000 because even the de-risk to 90% was the other 43,000 that you earned as a return. To be sort of totally transparent or simplify the matter, as you said, is you actually only invested 150. So you need to say, well, each year, this is what I'm getting on 150. Good luck. Go put that on the stock market. Let's see what 150 makes you. And at the end, I also want on the 10th year, I'd like to get 1.2 on my 150 as well.
Provided itself.
Sure, but the returns, we took that slide out here, okay, because it was a bit confusing. The returns are amazing. I said, we had this chat, no, I want to stay in, okay, because there's actually some great returns coming on the 11th, 12th. It's like 220 a year.
The debt's been repaid.
Yeah, I want to show that to you guys. We can discuss that. I mean, you are going to get proper financial advice and a discussion about this. This is the presentation.
In terms of the tax act, 12J, you had a term period. It was 5 years. You had to then sell off the asset. And many people who did invest are finding difficulty in trying to sell that asset. They can't get the money for it. Is there a term period in this 12J? 12B.
So on the 12J side, a lot of people are starting to exit because of the type of underlying investment. So if you invest into a private equity 12J fund or a tech 12J fund, you're going to struggle to get your money out. It's the nature of those investments, they're hard to sell. And if you invested in, for example, asset rental that we have, our investors within 4 weeks at the end of March, they've gotten their money out. So in this investment, it's 10 years. And the reason it's 10 years is because these type of contracts, to be competitive in the market, you need to offer long-term finance. Banks are offering 7-year terms. We couldn't go and offer 7-year terms. It's not competitive. If you offer 10 years, we say to investors, have the mindset of being in for 10 years, and then we're going to try and exit you. If you wanted, and I don't think it's really possible, but you could at any point in time sell your interest to someone else who would buy it and exit. No one's going to buy it, but you do have that option. We also, you know, there are human beings that run this business. So if, just like with 12J, if investors come to us with a personal situation where, you know, they need the capital, if there's liquidity, we'll do what we can and exit them. But the mindset we want investors to have is you in for 10 years, but yet you're de-risk 90% in year one.
So the actual investment that you make, deployment of the capital, installing the solar for various commercial operations, and they just pay you the charge of the electricity they're using and not paying at all for the actual solar.
Our preference is not to do a deal where they pay us for what they use. We prefer that they pay us for what we produce. There's a big difference. So if you install a solar system and the system is geared to produce 400 kilowatts a day, and it does, they pay us for the 400 kilowatts.
Not even if they don't use it.
Even if they don't use it. And the other way around is to say for them to only pay us for what they consume. The problem with that is if you have like a farming operation that has been hit by hail or there's a drought and now all of a sudden there's no production, no harvesting, the machine's not working, the bottling plant is working, they're not consuming electricity, then we're at risk. We're taking business risk and we're not in farming. I don't want to take that type of risk. And so I would say 80% of our transactions are fixed. Every month they pay us X, regardless of production. There's a small portion and the balance is then on output, but we are looking at deals where it'll be on consumption. But they are very technical and we're not going to take much risk. We'll do it for very specific industries and specific players, but we would look at it.
The ownership of that, the solar system, does never pass on to that.
It does. At the end,
They'll
buy it for R1.
Okay.
Because that's your turn to a 16-year.
Yeah. If you get to the 16th year, they'll just take the assets.
But they aren't. Your question coming back, circling back, they're not actually buying the asset.
No.
They
I
buy
understand that. Yeah,
electricity
I understand.
on a monthly basis on consumption.
Is there a minimum amount of investment that you are prepared to do?
Yes, it's 500,000.
500,000. So you've got to find a company, not as an investor, to deploy the actual.
Oh, to deploy.
Yeah.
Okay, sorry.
At the moment, it's 5 million.
Minimum 5 million.
at the moment.
Okay.
What we are looking at doing, and we're far down the road, is allocating a portion of the capital to transactions between 1 and 5 million rand. And we like this segment of the market because it's unserviced by the banks and the yields are very high. So at the moment, we're getting about prime plus 2, which is 13.75% as a yield. In that segment of the market, we can charge 18 to 20%. So we like that segment of the market. It's normally a healthy segment. So, for example, there would be a lawyer or an accounting firm. Small offices only need a million rand system. Great credit. So we're looking at this segment of the market very closely. We've got a team that are developing policies and rules, and we're doing at the moment we're due diligencing about 20 solar installers, and then we're going to look at deploying to this market. But this is a market we really want to get involved in.
Currently, how the law is written, there's no ceiling or cap on the amount of quantum you can invest, right? And do you think that will change in the next years?
I think so.
And secondly, in terms of the qualifying criteria to get the tax credit, in terms of capital gains tax, income tax, is there qualifying criteria with what type of tax qualifies for this regime? Or is tax how SARS see it for this particular section? So the company is paying CGT, income tax, dividend, does all of that fall into this cost?
Only this investment can only be used to reduce your taxable income. Now, taxable income, I think, is two forms of income fall in your taxable income. One is your normal income, salary, interest income, and the other is capital gains. So if I buy a business for $1 million and I sell it for 9 million, the 9 million of gain, 40% of that falls into my taxable income, and then I'm taxed. So that 40% falls into my taxable income, I can reduce that amount by Section 12B investment.
Thank you for that. I think what I like about this is what Nick explained about the stock market. Here you have an underlying asset at the end of the day. It's not just a hope of spares that something's going to increase. You have a contractual committed term whereby they buy the usage. You finance that. It's basically like a property net yield. You're collecting your money, and if there's a default, you still have 1 of 35 people defaulting, so your risk is mitigated. And at the end of the day, there's an underlying asset that the bank can put their hands on. So there's no real risk actually to the investor. Earlier you mentioned that you need a 125 cap, the 12B disclosure.
Yeah.
Can you just touch on that? So let's say, so you are exposed to that extent, but you still have an underlying asset that the bank must preferential credit drawing discuss against before they can default to you as the end investor on 125.
Banks can never come off our investors, never, under no scenario.
Right.
So, just to touch on the Section 12B risk, and I honestly don't really have any practical. I'll give you an example, but other than this, I don't really have other examples. But an example where this risk could materialize is if we, on this building, let's assume the fund is 100 million rand, we go and install solar on this building, and this building catches a light because of the solar, and the building burns down, and intellectual property and all other assets are now disintegrated. The property owner and everyone else will have a claim against us, negligence potentially, and they'll then sue us for more than 100 million rand. Now, in that scenario, if we lose and we are now liable for 200 million rand, our investors would have to put an additional 25%.
But it's capped at that 20%.
It's capped at that amount.
Okay.
Anything above it is my business's risk. So we are the general partner. We take all risk above that 25%.
Thank you.
Also, I think the other thing is we've got an affiliate partner, TaxIt. Some of you as clients have used them, whatever, and they are tax consultants, and they are really happy to discuss it. So in other words, instead of talking generally, if you bought a company, if you've got capital gains, if it's in your personal income, if you're a consultant, if you are paying PAYE, or if you are paying a provisional tax and you've got a consultancy and you're earning from 3 different or 5 different places, you understand that we can actually talk about your tax. It's not the theory of it. Look at your tax, do that. You also secured a really good fee from them. So, if you're really less complicated, it's about $1,000 and it's $3.5 grand for a really complicated commission earner, billable hours, maybe like an attorney or whatever. There's something that's a small practice. So I think, guys, that is really competitive. We wanted to take that, out of the, the issues of like, well, how does it work? Let's consider it does work and it is right. and the tax expert will vet that and do your tax return as well. So we wanted to just offer that as a complete wrapper for Mont Blanc. So I think it's quite nice.
Right. Ultimately, if you're not paying tax, I would not recommend investing in this product. So to have someone who can guide you that.
And I like your statement here. We've always spoken. It's like, cool, it's no problem. If you feel you're getting value from the roads and the potholes and all the corruption, pay your tax. Pay it. But you've got a legal way out, okay, of not paying your tax. I mean, it's like the door's wide open. There is one caveat. Some of you have realized it. If you're a PAYE earner, you now have to outlay that money and you will only receive it back after your financial year end closes 28th Feb. You pay your tax, you submit it, and you're going to get your return. So there is, a time lag for you having to lay out your 500,000 or million rand and then wait for it back. So it's a cash flow outlay because you have to invest now. Lights have to be on the solar panels and everything by 28th Feb, correct? Okay, so they got to deploy it. Then you can claim. You get a certificate, it's all kosher, you can do that, and we're obviously going to help you with it. We are working on it, it's not now, because obviously after this tranche closes, guys at Jaltech have got a new structure coming that works on the 100%, but obviously the 125 is nice and maybe never to come. And if it does, great. Guess what? The good news is you have to pay tax next year again. Okay, so you're going to redeploy. If it's working for you, you're going to do it again. Okay, but the next year, or in all likelihood, it's not going to be as sweet. It's going to be 100%. But without letting the cat out the bag, the gearing will be different. Maybe it's not 40% or 50%. Maybe it's 70%. So you get more money from the bank. So you've actually spent more. There's interesting things going on out there for the next financial year, and that will launch in 6 to 8 weeks. But what I like about your company and about Jaltech is this is all you do. Okay, there are other companies out there that mess around in lots of other things, ESG, environmental investments, and they're busy with lots of things. And this is just one thing they do amongst many things. Okay, these other companies that are into the sort of environmental stuff, and it's great. But I like the fact that Jaltech focuses solely on this, and this is like your mission.
Yeah, it's our main focus in this one.
Yeah. Cool. Any other questions, guys?
Just a last question.
Yes.
I mean, it's all well and good. Jaltech, well done. But you talk about management fees.
Yeah.
And that's normally a sore point among many investors.
Yeah. And I'm happy to talk about it. So the amounts, all the figures I showed you earlier were all after fees. We charge 2 fees. Our annual fee is 2.25%, and that goes towards the team to run this fund. It's very staff heavy and professional staff heavy. 6 financial professionals, soon 3 lawyers, and lawyers are expensive. And lawyer.
Why are you looking at me?
You mentioned a lawyer. I used to be a lawyer, very expensive. Worth it. So that's our annual fee, and then we charge a performance fee. Our performance fee is we have a hurdle. Our hurdle is roughly 10%. If we don't hit our hurdle, we don't earn a performance fee. We need to then catch up on our hurdle the following year before we can earn a performance fee. And what you want as
you want them to have that performance.
You want us, it's a long-term investment. It's 10 years. You want us to be incentivized on an annual basis for this investment to perform. Otherwise, your returns are going to be poor. So we incentivize every year. There's a lot of work in finding these investments, managing these investments, deploying the capital, and then managing these assets, making sure that they're maintaining them, and we collect the capital every year. So
I think you're earning 20% on over and above the rate.
Yes.
Okay. So I want to tell you this, guys, is if you go and you're welcome to go and look around in the market. I found the creme de la creme. This is not the OK bazaars. This is not the cheapest oaks in town. There's a lot of other motley crews that put stuff together. They're getting the thing. Maybe the fee's better, this, that, whatever. But Mont Blanc as a company, we got a lot of clients that we can't, sort of pin ourselves to a fund manager that we can't have faith in that they're going to deliver. So for us, maybe there's these guys out there charge 2, 1.8, 1. I don't know, guys. At the end of the day, a lot of the guys, I never went further because I didn't feel the structure was right. And I will say this, credit to your team, is that all your investments are creme de la creme. It's top guys, A-rated, who you renting, who your clients are that are actually taking electricity from you are like top notch. Which I think that's one of the things you pride yourselves on, and you chase that hard. You give them the term sheet, you give them the deal within 4 to 4 weeks. Maybe Standard Bank or maybe Nedbank's going to come back to them. There are valuable clients for the bank, so they will give them finance. But these guys come back quick. And I think that's the big difference, is by the time the bank comes and accepts, it's over.
Yeah, I think to your point, and to give you some peace of mind around credit is, we've just raised 150 million rand for our so last year's investment was invested with us, we deploy that capital, and only in the next financial year do we raise the debt. Off the back of the businesses we did deals with last year, we raised 150 million rand. And what that tells you is that the bank, our banker, RMB, have gone and had a look at our underlying investments, and that they're comfortable with them, and they've given us 150 million rand to finance solar for our existing investors. So, I can tell you that is what you want to hear, credit perspective.
I don't know if there's any other questions. I mean, I know there's some of you here have had chats with myself or one of our financial advisors, and you already are quite comfortable and are going to invest. And this today was a sort of double check, sort of as we say, get it from the horse's mouth. But I mean, the other questions that have come up, and I still say the example is using the tax man's money. And I think I just want to say is, when you start thinking about this, just remember, on R1 million, you've only committed 150,000. Okay, I want you to really take it off the table of that, will I get your tax back? You get it back, guys. Please talk to your uncle that's in tax, brother, your cousin, all the experts we've given you, and you can have a consultation. There's no cost to that, to talk to tax it. That absolutely comes back. So if that's an absolute guarantee that you get that back, then you've only spent 150,000 to have a return here. So your risk is really minimized. As soon as you get to 43,000, just round it up, you basically only spent 100 grand for this investment straight out the gates on the first year. So for me, it is a no-brainer, but yet there is that cash outlay for your PAYE. So we are going to bring a product out which we are happy to do, but it's not now. We will bridge that finance. We'll give you a short-term finance bridging thing so that you can pay it. And there's some people out there that unfortunately they've spent the tax. They haven't saved the money and XYZ, but if you have access to it, it's a no-brainer. Within months, you're getting it back. I mean, it's like a 6-month, pretty much. Yeah. Any other questions, guys?
Thank you.
Just one quick question. As far as I know, according to VRC 88, it says you need to prove ownership of the equipment in order to claim down 25% tax deduction. Have you guys breached that?
I'm smiling because I don't think a lot of people know VR 88. So that was the ruling that was issued in February this year.
That's right.
And proving ownership is very simple. Our investors invest into a structure which is a partnership. So a partnership structure is your typical private equity structure in common partnership, and they sign a deed of adherence, which now commits them to the partnership, and now they're a partner in the partnership. This partnership buys the solar assets, it owns it. It has a title to these assets, and that is enough for SARS to for you to claim a tax benefit. And how the tax benefit is claimed from a SARS perspective is we issue a statement. The statement has information such as the partnership name, your interest in the partnership, the revenue of the partnership, the expenses, the allowances. And that information then gets plugged into e-filing. And you plug that in, SARS then calculates what your tax deduction, and assuming you're not audited, that's as far as it goes. If you then get audited, SARS will then ask for information such as proof that the assets were in production. We have something called certificate of completion, certificates that the installers issue us, dated, some with the beta dating, and we'll then issue that to SARS. You comfortable with that answer?
Also, I want to say, how many investors have you? I think it's like 1,700.
In this 400,
In total?
1,700.
1,700. So I don't know my numbers.
How many
So-
got audited in the application?
So
Good question.
for our, so we closed our last year we had 3 funds. We closed our funds obviously in February. 400 investors. I would guess that 30% of those investors were provisional taxpayers. Not a single investor, and they would have all claimed their 12B benefit. Not a single investor has come to us with an issue from SARS. We've now been many months, so I assume none of them have been audited. For our POIE payers, they are now in the process of doing their submissions. We assist where we can. We have a guide, which is a step-by-step process, guides them through the process. And we're working with an accounting firm that have, for a number of years, assisted clients with claiming their 12B benefit through these type of structures very successfully. And we're extremely confident that our investors will get the tax benefits.
Yeah, but as Mont Blanc clients, like I say, you'll have access to tax it.
No, so you wouldn't want to trigger an audit.
No, sure, but it's 100% legit. And the thing is, I want to also say is that your thing is not some weird installation that you did yourself with a friend. Okay, they're used to seeing Jaltech's certificates, your paperwork has been seen by SARS a lot, guys. So people get into it's that. No, we know what that is. It's not you put some solar on your farm and you're now trying to claim it. And they've never seen.
As I was saying with our 12J investors, more than 1,200, every single one of them got the tax benefit. So, and some were audited. We assist with the audit process. We know what documentation to make available and how SARS wants it presented, and we'll assist. Will some investors get audited for sure? Most likely for something other than 12B, but it is possible.
But you do know that a silver really comes back to after 3-4 years.
Not in my experience.
We've seen it.
Sure, but it's 100% legal. It's not a grey area, guys. You need to understand it's not something that the tax practitioner at SARS cannot argue this. It's in legislation, it's in law. You apply it that way.
Okay.
It's not a sort of
Right.
up for debate for them. I hear you. Like you say, you could be audited for something else.
Yeah.
Okay, guys. We're going to have something to drink outside if you guys want, and we can chat.